Hi everyone, welcome to this session on payroll basics. Whether you are new to HR, accounts, or just trying to understand your own salary slip, this training will walk you through how payroll works behind the scenes. By the end of this session, you'll be able to read a salary slip confidently, understand your deductions, and even explain it to someone else. For those of you working in payroll or HR, this is a strong foundation for managing salaries compliantly and effectively. Alright, let's begin with the most fundamental question: what exactly is payroll? Payroll is the entire process of compensating employees for their work. It's not just about transferring salaries into the bank account, it's a system that calculates earning, applies legal deduction, keeps record, ensures timely disbursement, and maintains compliance with labor and tax laws. Payroll management covers everything from understanding an employee's salary structure to calculating taxes, managing loans, and generating payslips. It's a structured system that keeps your workforce paid and the company compliant. It all starts with the salary details laid out in your appointment letter. That's your paycheck blueprint. From there, the system generates a neat payslip showing what you have earned and what's deducted. Think of deduction as the mandatory subscription, statutory ones like PF, ESI, PT, and income tax, and some optional ones too. Then comes the wildcards: arrears, loans, leave without pay, proration, stuff that depends on what's happening in your work life. Together, these bits ensures payroll isn't just about getting paid, but about keeping it fair, accurate, and legally on point. The appointment letter is the foundation of payroll. It defines salary components, payment frequency, and the term and the condition of employment. For payroll processing, this is the source of document that gives you the master data to determine monthly salaries. If you are in HR or payroll, always refer to this before making any salary changes. A payslip is like your financial diary for the month. It tells the story of what you earned, what was deducted, and why. It's shared by your employer to give a clear breakdown of your salary for a particular period. It typically shows your personal and employee details, the company's name and address, your salary structure, attendance, and any loan repayments if you have taken. In short, it's your paycheck explanation letter, friendly, transparent, and full of little clues about how your monthly income came together. There are two types of pay slip: admin slip and economic slip. An admin pay slip typically refers to the salary slip generated for an employee with administrative privileges, often someone in HR or payroll who manages or accesses pay slips for others. It can also refer to the payslip viewed or downloaded by an admin for an employee in the system. The admin payslip usually includes only earnings, deductions, and net salary. The term economic slip isn't commonly used in payroll or financial documentation and may be misinterpretation or shorthand for something else. It typically includes the employee's earning, deductions, net salary, and income tax computation sheet. Salary is the periodic payment made by an employer to an employee in exchange for the work or services they perform. It usually disbursed monthly and may be paid in various forms such as cash, check, demand draft, or more commonly today, bank transfer. Your salary isn't just one lump sum, it's made of different moving parts, kind of like ingredients in monthly financial recipe. At the heart of it are earnings, which is the total amount your employer pays for your work. Recurring elements are the familiar, consistent portion of your pay, the ones that show up like clockwork every month. Think of them as your main course salary items: basic pay, house rent allowance, travel allowance, and so on. These are called master salary components because they are steady and predictable. Then there are non recurring elements which are more like a surprise dessert or seasonal specials. These include bonuses, incentives, overtime pay, things that don't appear every month and depend upon specific situation or performance. These are sometimes called variable inputs or one time payments and can change from month to month. Every month, when your salary comes in, it's not just income, it also includes a few quiet subtractions. These are called deductions, and they're not about taking away, they are about balancing responsibilities and benefits. Recurring deductions happens regularly, like clockwork. Think of provident fund, income tax, professional tax, labor welfare fund, and ESI. They are statutory, which means the government requires them. You contribute a small part of your income each month. Some go into your saving for your future, and some ensure you're staying compliant. The non recurring deductions aren't part of your monthly routine, they pop up once or occasionally. A deduction for the company canteen, or maybe a one time recovery for a misplaced item. They are temporary, specific, and often tied to unique events. Net salary, it's a part of your paycheck that makes it to your bank account. The part you can save, spend, or celebrate with. Think of your gross salary as the full pie, everything you have earned, including basic pay, allowances, bonuses, etc. But not all of it lands in your wallet. First, these are the gross deductions like taxes, provident fund contribution, professional tax, and maybe a health insurance premium. These deductions aren't random. They go towards your future, your benefits, or your compliance with law. What's left after all that is net salary, which is also known as take home pay. It's the final amount paid out to you reflecting what's your after doing the math. In short, it's the money that powers your everyday life, which is rent, bills, streets, and maybe that weekend getaway you have been eyeing. Because behind every payslip is a simple question: earned, subtracted obligations, it is what yours. Statutory deductions might sound heavy, but they are just the necessary contribution pulled from your salary by law. Think of them as your monthly check ins with the government, helping support everything from retirement plans to healthcare. These deductions aren't random, they are governed by official rules and serve real purposes. Whether it's your provident fund, income tax, or professional tax, each one plays a role in funding services that matters to your long-term well-being or society at large. So while it may feel like a chunk missing from your paycheck, statutory deductions are more like investments. Some go towards your future savings, others go help stay compliant and secure. It's a payroll and policy working together to keep things balanced. Provident fund is not like any other deduction made from your salary. It's your silent financial partner working behind the scenes to secure your future. Your contribution every month is you invest 12% of your basic plus dearness allowance plus VDA towards PF. Think of it as your financial support system. Let's move to our employer's contribution. Before that, you need to understand the twist. 8.33% goes towards your employer's pension scheme, your post retirement income stream, and the 3.67% joins your own PF contribution to form a growing fund in your employee provident fund, which you can access during any emergencies. Now let's discuss why PF matters. PF is not just about numbers, it's a long term safety net. EPS gives you a monthly pension when you hang up your work boots. Together, this they help you build financial stability without even lifting a finger after your monthly contribution. In a world of instant expenses, PF quietly does slow and steady work. And years from now, you will be looked back and thanking your younger self for choosing security with every paycheck. When the salary gets processed, a few important deductions are made to cover benefits and legal contribution. One of these is employee state insurance. Think of ESI as a social safety net. It's there to support your medical needs and other essentials, just in case life throws a curveball. Now, not everyone gets covered under ESI. If your wages are 21,000 or less per month, you are eligible. The deduction works like this: you contribute 0.7% of your gross salary, and your employer adds 3.25%. It's a small slice that goes a long way in securing healthcare, maternity benefits, and even dependent support. Here is a fun wrinkle: your ASI eligibility follows two cycles every month: April to September and October to March. Now, let's say you get your salary hike midway through a cycle. Even if your pay crosses 21,000, you might be still eligible for ESI till the cycle ends. So, you won't lose benefit abruptly. ESI is more than deductions, it's a protection, continuity, and making sure employees and their family have access to support when they need it most. Professional tax is a state based tax levied on all professionals and employment. Deduction is made on the basis of salary slabs as prescribed by the respective state government. Every month, a fixed amount as prescribed by the government is deducted as professional tax. This deduction is mandatory in the states where PT is applicable. The Labour Welfare Fund is a statutory contribution managed by individual state authorities to provide social security to workers. This deduction is applicable in specific states and as per the rules specified by respective state governments. It's a small deduction made either monthly, half yearly, or annually. It applies to both employees and employers, and the contribution amount varies by state. When it comes to your salary, there is more happening behind the scenes than just money in, money out. The government requires employers to deduct certain amounts from their pay to keep everything compliant and fair. Income tax is calculated based on your total earnings over the financial year, which starts from 1st April and ends till 31st March. It takes into account what you have earned from your current and previous jobs, any perks you received, and allows for exemptions and deductions under different sections of the Income Tax Act. Once those are applied, your taxable income is figured out and the tax is deducted accordingly. This whole process isn't random, it's governed by laws and handled by your employer to ensure your contribution goes to the right places. So, the payroll processing includes salary sheets, attendance data, pay slips, bank transfer, income tax computation, TDS return, and statutory compliance. Proration might sound like a payroll jargon, but it's really just about being fair when someone doesn't depend the full month on the company's role. If you're a new joinee starting mid month or wrapping up a final day before the month end, your salary isn't calculated the same way as someone who's there all month. That's where the proration step in, like a quiet accountant making sure your paycheck reflects the exact number of days you worked. It's based on your wages rate and the number of days in the month. When you joined a company on 15th or left on 23rd, proration ensures compensation is proportional because every day counts and every contribution matters. Now let's talk about an example where Ashok joined a company on 16th July 2025. At the end of the month, he noticed that his salary was less than expected, so he wanted to understand why. The reason is simple. Since he joined mid month, he is paid only for the 16 days he worked. This is called a prorated salary. The calculation works like this: each salary component is divided by 31 days because July has 31, and then multiplied by 16. For example, his basic is 8,000. When divided by 31 and multiplied by 16, it comes out to 4,129 rupees. The same method is used for all the other components, and the total gives his payable salary for July. So, this is how salaries are calculated when someone joins or leaves partway through the month. Whenever we hear someone say, I am getting arrears this month and trying to understand the meaning, today we'll break this down. Arrear is the money that should have been paid in to you earlier but wasn't paid. It can be for any reason, for example, salary revision, a missed payment, or maybe your data affected when you actually salary kicked in. There is something more to understand for arrears. Sometimes arrears also refers to how payments are scheduled. If your salary is paid at the end of the month after you have worked, that's payment in arrear. If it's paid at the start of the month before you worked, that's payment is advance. It's just about time. The final amount usually depends on the wages and how many days you have worked in the month. Now let's understand area concept from different perspective. So if you're a new joinee and you joined late in the month of May, but your paperwork was finalized only in June, areas step in to make sure you have paid for those late May days. You weren't missed, just fashionably late in the system. Now imagine your salary increases effective from December, but the update rolls in February. Arrears make sure you still get the extra pay for December and January. It's payroll making sure you're retroactively recorded. Maybe the salary wasn't processed last month and now it's being late with a slight delay. Arrear kicks in to fill the gap from the missed month because you did the work and system is catching up. Now let's take an example to understand how actually the areas work. Suppose Ashok joined a company on 27th July. Since he joined at the end of the month and payroll for July was already processed, he didn't receive any salary for that month. Instead, his salary for 5 days in July will be paid in the August as arrears. To calculate the arrears, again the each component is divided by 31 days as the July month has 31 and then multiplied by 5. Let's take another example where Nathan's increment was due in April 2025 but it was approved later in July with effect from 1st April. So the difference in salary for April, May and June was calculated and added to the July as arrears. A loan is basically someone trusting you with their money with the understanding that you'll pay it back. It's like saying, I have got you covered for now, but it'll need to be back later. The person or organization giving the money is called the lender, and the one receiving it is called the borrower. But that's not all. The lender often charges a little extra for the favor. That extra bit is called interest and it's calculated based on the agreed percentage. So when you take a loan, you're not just promising to return the money, you're also agreeing to pay a little extra as a thank you for the support. Loans come in two broad flavors, those that charge interest and those that don't. The first kind, interest bearing loans, are what we typically think of when borrowing from a bank. You get the money now, but you repay it in installments with a little extra on the top, called interest, every month. That extra amount is a thank you fee to the lender for trusting you with their money. Homes loans, car loans, personal loans, they all fall into this category. Then there is a more generous kind, non interest bearing loans. These are that we trust you, no string attached loans, usually offered by your company. You're expected to return just the amount you borrowed with no added interest. The monthly payables are straightforward, your EMIs equal the principal. Think salary advances or festive loans like Diwali or New Year advances. You know those days when you need to take off from your work but you have already used up your paid leave. That's where loss of pay comes in. Loss of pay simply means your salary takes a small hit because you have taken time off without approved leave or without any leave balance left. It's not a punishment, it's payroll doing its job fairly. If you are away for a day, a few hours, or even just a minute that aren't covered, the system calculates what you owed based on your wage rate and deducts the difference. Think of it like this: if you have borrowed time, LOP makes sure your paycheck reflects it. It's about keeping things transparent for you and for the company. You'll usually see it broken down by the number of LOP days or hours and the specific dates when they occurred. Not every leave fits neatly into the system, and LOP is how payroll ensures your time off still gets accounted for with clarity and accuracy. Now let's understand this with the help of an example. So suppose Raju was on leave from 9 to 16th July but had only 2 paid leaves. So 5 days were considered loss of pay. To calculate this, his monthly salary is broken down per day and then multiplied by 5 days. This amount is then deducted from each component of his salary. You know how sometimes your salary gets deducted because you have taken extra time off. That's called loss of pay. But here's something a lot of people don't know. You can get some of your money back. Loss of pay restoration is a payroll's way of saying, hey, you worked extra this month, so let's return what you took earlier. Maybe you made up for those leaves in days in the following month, or HR cleared your pending leave record. If you had loss of pay deduction in, say, June and July, you worked hard and your records were updated. You could see some of the amount restored. The catch? You can't restore more than what was deducted. So, if 5 days' pay was cut earlier, LOPR can bring back those 5 days, not more. It's quite fixed but thoughtful one. Because behind the payslip math, it really is about making sure you have paid fairly for every day you give back to work. Now let's take example of the same. Supreet was on leave for 5 days in June, but no leave was recorded, so LOP was deducted. In July, he updated the leave details and requested LOP reversal. Since the LOP was for 5 days of June and amount is restored in July's salary. Imagine you are trying to figure out how much tax you will be paying this year. But all those section numbers and deductions feels like a nightmare. That's where the income tax computation sheet becomes your calm in the tax storm. It's basically a financial map of your year. It starts with your gross salary, adds any extra income like perks or earnings from a previous employer, then subtracts what you are eligible to save through the tax exemption, standard deduction, and all those chapters 6A investment you made. Think insurance premium or contribution to your PF. Once everything added and subtracted, what you are left with is your taxable income and the number of governments look at to decide how much tax you owe. The sheet may even include reliefs like section 87A to ease the final bill. In short, this isn't just paperwork, it's your tool to make smart, legal choices and minimize what you pay. Because planning taxes isn't it just about money, it's about peace of mind. Reimbursement might sound formal, but it's just a practical way of your workplace to say, hey, thanks for covering that, here's your money back. Sometimes you spend your own money while handling work related stuff, be it looking a cab to meet a client, buying meds after a hectic on site, or even topping up your internet for your work from home calls. Reimbursement ensures those out of pocket expenses don't fall on you. It's not just about getting paid back, it's about trust. You step in to get things done, and reimbursement makes sure you're not left footing the bill. You have wrapped up your time at the company, whether it's a fresh start elsewhere or well deserved retirement. And now comes the part that feels like a little transactional, the final settlement. But it's more than just the numbers. It's how the organization ensures that everything you have earned, which is salary, gratuity, leave encashment, any other dues, is paid fairly. It's also advances or unpaid leaves. It also when the company checks if there is anything that needs to be recovered, maybe a salary advances or unpaid leaves. The goal? A clear slate on both sides. Think of final settlement as payroll's parting handshake. It's the system way of saying thanks for your time, effort, and contribution. We are making sure you leave with no strings attached and every due in place. And that brings us to the end of today's training session. Thank you all for your time, energy, and thoughtful participation. When you were asking the tough questions, sharing experiences, or quietly soaking it all in, your engagement made a real difference. We hope this session gave you clarity, confidence, and a fresh takeaways to put it in practice. As you head back to your roles, remember learning doesn't stop here. Stay curious, stay connected, and don't hesitate to reach out if you need any support. Until next time, keep exploring, keep evolving.